Right now, global militaries are essentially trapped in this economic suicide loop.
Yeah, that is probably the best way to put it.
I mean, think about it. They are firing these million-dollar, highly complex kinetic interceptor missiles, right?
Yeah.
And they're using them to shoot down like $10,000 off-the-shelf commercial drones.
Right. Which is just mathematically unsustainable.
Exactly. It's an asymmetric cost equation, and it heavily, heavily favors the attacker. It's slowly bankrupting Western defense procurement budgets.
Completely bleeding them dry.
But today, you are listening to The Deep Dive, and we're looking at the company that just figured out how to break that loop.
And they did it with light.
Literally with light. Welcome to The Deep Dive, where our mission is professional earnings, called summarization. We are here to cut through all the noise and bring you, the experienced investor, the absolute signal. Today, our focus is squarely on Elbit Systems and their fourth quarter 2025 earnings. And look, if you have been, watching the tape this week, you already know.
The tape is screaming right now.
Yeah, the market is aggressively validating these results. We are not talking about a cautious hold here or a stock that's simply drifting on broader market beta.
Not at all.
The sentiment is fiercely constructive. What we are witnessing is a true breakout compounding story.
The price action is, frankly, reflecting a massive structural re-rating. It is the market finally waking up to a fundamental reality that's been building underneath the surface for several quarters now.
Yeah, the company is completely shedding its historical identity.
Exactly.
And that is the core premise we need to establish for you listening right now. If your models still have Elbit pegged as this diversified regional defense supplier operating primarily in the Middle East,
you need to update your priors immediately.
Immediately. What this specific quarter proves is their evolution into a globally scaled, capacity-constrained rearmament platform.
A completely different beast.
So let's just begin with a summary of the results, just to understand exactly what triggered this massive market reaction, and then we will go in depth into the mechanics of how they actually pulled this off.
Let's do it.
All right, so let's look at the top line. Fourth quarter 2025 revenue came in at $2.149 billion.
Huge number.
Yeah, that is up 11.3% year over year. But beyond just the percentage growth, there's a major psychological barrier that was breaking here, right?
Oh, absolutely.
This is the very first time their quarterly revenue has ever crossed the $2 billion threshold.
And it is a critical milestone because, defense revenues are notoriously lumpy.
Right, very project dependent.
Exactly. So when a company crosses a threshold like $2 billion in a single quarter and comfortably beats the consensus, which was sitting in that 2.09 to 2.1 billion range?
Yeah, right around there.
Right. So when they beat that, it signals that the lumpiness is finally smoothing out. The sheer volume of concurrent programs has essentially created this continuous compounding revenue curve.
But the top line is really only half the story here. I mean, the bottom line was an absolute blowout.
Crushed it.
Non-GAAP diluted earnings per share came in at $3.56.
Which completely crushed the street consensus. Analysts were looking for somewhere between 3.18 and 3.23.
Yeah, nowhere close. And just for context on the GAAP side, GAAP EPS was 3.52 versus 2.00 flat a year ago.
That's massive.
Yeah.
And we also saw a huge expansion in profitability metrics. Non-GAAP operating margins hit 9.8%.
Stepping up from 8.2% last year.
Right. And the free cash flow generation was equally aggressive. I mean, they printed record free cash flow for the year of $553 million.
Which is up 73% year over year.
Just a cash generating machine right now.
But, I would argue all of the revenue, the margins, the cash flow, it's all a lagging indicator.
Okay.
The most important number printed today, the number that dictates the future cash flows of this business, is the backlog.
Oh, without a doubt.
A staggering $28.1 billion. That's up $5.5 billion year over year.
That $28.1 billion is the gravity well that the entire long-term investment thesis revolves around.
It really is.
But to truly understand the mechanics of this quarter, we cannot just look at the aggregate beats. We have to dissect the segment-level data.
Under the hood.
Right, because the aggregate numbers hide the actual transition happening in the product mix.
Okay, well, let's tear down those segments. When you look at the product mix driving those expanding margins, the absolute star of the show was the ISTAR and EW segment.
Yeah, that was incredible.
And for those who might not live in this acronym soup every day, that stands for intelligence, surveillance, target acquisition, and reconnaissance, along with electronic warfare.
The really high-tech stuff.
Exactly.
Yeah.
That segment was up 39%.
Wow.
Land systems were up 22%. C4I and cyber up 19%.
Huh.
Really, the only drag on the entire board was aerospace, which was down 14%.
Right, but let's contextualize that aerospace drag immediately so it doesn't cloud the broader picture for anyone listening.
Yeah, please do.
That 14% decline was almost entirely due to the timing of European training and simulation deliveries, combined with exceptionally tough year-over-year comparisons on precision-guided munitions from late 2024.
Got it. So it's an accounting artifact.
Exactly. It is an artifact of the accounting calendar, not a structural demand issue at all. The real signal is that 39% growth in ISTAR and electronic warfare.
Yeah, almost 40% growth in a single segment for a defense prime is unheard of.
Right. And that specific growth vector is what is driving the operating leverage. It is the engine behind that 9.8% non-GAAP operating margin.
Which marks 4 consecutive years of margin expansion. But let me push back on that for a second.
Thanks, Kurt.
Because this is the primary debate happening on trading desks right now. Is this actually operating leverage, or are we just looking at peak margins driven by emergency wartime pricing?
Ah, the classic cyclical defense trap.
Exactly. It's the trap. Defense companies enjoy temporary pricing power during a geopolitical crisis. Margins expand, the street capitalizes those peak margins into perpetuity, and then the conflict cools off and the stock craters.
Right, they get stuck holding the bag.
So are we sure this isn't just price gouging on basic artillery shells? Like, how is this different from a SaaS company that finally covers its fixed server costs and sees every new subscriber drop straight to the bottom line?
It's actually a lot closer to the sauce analogy. And it is definitively not wartime price gouging on dumb metal. Understanding the why behind these margins is crucial for anyone modeling the stock.
Okay, unpack that.
This expansion is sustainable because of the underlying nature of the products they are actually selling now. A 39% growth in ISTAR and electronic warfare means they're actively shifting away from just bending metal and moving toward highly complex, software-defined platforms and AI-enhanced systems.
Right.
Electronic warfare today is not just, jamming a radio frequency like it was 20 years ago.
Right, it's not just static.
Exactly. It is full-spectrum dominance. It relies on advanced processing, highly sophisticated algorithms, and digital architectures.
So the fundamental economics of the business are changing.
Completely.
When you sell, like, a software upgrade for an active protection system on a tank or a new digital architecture for battlefield command and control, the incremental gross margin on that specific sale is astronomical compared to manufacturing a physical tank chassis.
Exactly. It's software margins versus heavy industry margins.
Yeah.
The initial research and development to build that software architecture is obviously a massive fixed cost.
Sure.
But once the code is written and the algorithms are trained, deploying it across thousands of international allied platforms scales beautifully.
Drops right to the bottom line.
Right. The margin expansion is the mathematical result of this software-heavy, technology-centric product mix becoming a steadily larger percentage of total revenue. They are migrating from a traditional hardware contractor to something much closer to an enterprise technology provider.
Okay, so margins expanding because of a structural shift in the product mix makes perfect sense. But here is the mathematical wall Elbit hit, and we have to talk about this.
The domestic market size.
Yes. The entire Israeli domestic defense budget simply is not large enough to support a $28.1 billion backlog. It is fiscally impossible.
Yeah, the math just doesn't work.
To achieve this scale, they had to engineer a completely new export strategy. Which brings us to the geographic pivot. This massive revenue beat was fundamentally an international story, right?
Absolutely. With Europe serving as the primary growth engine.
The geographic data is just definitive here. 72% of that $28.1 billion backlog is sourced entirely outside of Israel.
Think about that. 72%.
It's wild. For the full year 2025, Europe accounted for 27% of total revenues. That means European revenue alone surpassed the $2 billion mark.
Which is staggering when you think about where they were just a few years ago. Europe is now the single largest driver of growth for the company, followed by North America at 21% and the APAC region at 16%.
To understand how they penetrated the European market so deeply, because that's not easy, we have to look at the product fit. Specifically, the undeniable commercial success of the PLS rocket artillery system.
The PLS system is a masterclass in product market fit.
The backlog for PLS alone has now surpassed $2 billion.
And it gained that kind of traction because of its modularity. European militaries have historically been burdened by these highly fragmented proprietary systems.
Like every country has their own weird custom tank or launcher.
Exactly. And PLS changes that. It is designed to fire multiple different types of rockets, varying ranges, different payloads, all from the exact same launcher platform.
Oh, wow.
Yeah, it provides extreme flexibility without requiring a military to maintain, 5 different types of artillery vehicles and 5 different supply chains.
But the real genius behind the European expansion is not just the engineering of the launcher itself. It is the geopolitical structuring of the sales strategy. We really need to unpack this European strategy for the listeners.
This is my favorite part of the story.
Because European defense procurement usually moves at the speed of continental drift, right? And it is fiercely protectionist. You cannot just export Israeli hardware on a boat to Berlin and expect to win a multi-billion-dollar domestic contract.
You absolutely cannot. It will get blocked immediately. European defense ministries are under immense domestic political pressure. When they spend billions of euros, they are mandated to create local jobs, support domestic industries.
Keep the money at home.
Exactly. And most importantly, they have to maintain sovereign control over their critical defense supply chains. If a conflict breaks out on their border, Germany cannot be reliant on a supply ship arriving from the Middle East.
Right. So Elbit utilized what I like to call an API integration strategy for heavy artillery.
Oh, I love that comparison.
Think about enterprise software, right? A company like Strike doesn't build the entire e-commerce website. They just provide the highly complex payment processing backend, the API, and they let the brand put their own logo on the front end. Elbit did the exact same thing with sovereign defense. They formed strategic joint ventures with KNDS and Dell in Germany.
It is a brilliant way to bypass protectionism. Elbit provides the core technology, the launch pods, the firing algorithms, the advanced guidance systems.
The brains of the operation.
Right. But they let KNDS and Dell, which were established, trusted European prime contractors, build the physical trucks, assemble the systems, and act as the face of the program.
So they are not selling a foreign system at all.
No, they are building localized European systems. The manufacturing happens in Europe by European Union workers, managed by European executives.
It completely neutralizes the political friction.
Exactly. The local prime contractor gets the headline revenue and the political capital, while Elbit collects the high-margin technology licensing and core component revenue.
It's basically a royalty model on heavy weapons.
Pretty much. Furthermore, it makes the system incredibly sticky.
How so?
Well, once a European nation adopts Europedos, integrates it into their command and control network, and spins up local maintenance depots and domestic production lines, the switching costs become impossibly high.
Oh, I see.
It essentially becomes the de facto NATO standard by default, locking out competing systems for an entire generation.
That's incredible foresight. And speaking of that European momentum, there is a massive catalyst watch right here that we need to highlight for anyone tracking this. The recent Hellenic Parliament budget approval for the POLS system in Greece.
Yes, the critical detail for anyone building a model right now is that this Greek budget approval is absolutely not included in the $28.1 billion backlog yet.
Wait, really? It's not in the $28 billion?
Not a single dime of it.
So it is a massive embedded call option.
The completely unpriced catalyst. The Hellenic Parliament has officially approved the funds, which is historically, the hardest political hurdle to clear in Greek defense procurement.
Right. The politics are always the bottleneck.
Exactly. But because the final contract ink is not physically dry, conservative accounting principles keep it completely off the current backlog.
Fascinating.
When that contract is formalized, it will represent another massive top-line addition that the street is just currently ignoring.
Wow. But let's pause and look at the divergence in the growth rates here, because it creates the central tension of the entire company right now.
The bottleneck.
Yeah. The backlog grew 24% year over year. But the actual revenue only grew 16%.
That delta is the physical bottleneck.
Exactly. That delta means demand is drastically outstripping their current supply capabilities. They are selling these systems much, much faster than they can physically build them.
Which, sounds like a great problem to have on paper.
Right. Everyone wants too much demand.
But if demand outpaces supply for too long, customers cancel orders and go elsewhere. They literally can't wait.
Exactly. The entire investment thesis we just laid out hinges on one single variable: execution. How fast can they physically pour the concrete and build the factories to burn through a $28.1 billion backlog?
Management is acutely aware of this. Which brings us to the execution engine: capital expenditures, physical capacity, and the supply chain.
Right.
They are attacking this bottleneck with significant capital. They are guiding to raise 2026 CapEx to roughly $300 million, which is a really steep step up from the $225 million they deployed in 2025.
Okay, so where is that 300 million actually going? Because we are talking about physical constraints. So what is the real world application of that capital?
It is being deployed into heavy industrial capacity and advanced electronics manufacturing. Most notably, they are tripling the physical footprint of their primary munitions factory in southern Israel.
Tripling it. Wow.
Yeah, they're also rapidly expanding electronics assembly facilities across both Europe and the United States. And to maximize the output of these new footprint expansions, they are running the facilities on 3 continuous shifts.
Just running at 204/7.
Basically. But the most important operational upgrade is the integration of robotics and artificial intelligence directly onto the factory floor.
I want to focus on that robotics aspect. Because automating defense manufacturing is notoriously difficult. The tolerances are so incredibly tight.
Right, it's not like making a toaster.
Exactly. You aren't building commercial sedans. You are building precision-guided munitions where a microscopic defect causes a catastrophic failure.
Which is exactly why they're deploying AI-driven automated optical inspection. Instead of human inspectors trying to spot, hairline fractures in artillery shell casings or microscopic solder bridging on a circuit board.
Which human eyes get tired doing.
Exactly. Machine vision algorithms scan every single component at high speed. It drastically improves manufacturing yields, reduces scrap rates, and ultimately accelerates total throughput.
But here is the most fascinating detail about this capacity expansion, and it is something that is easily missed if you just skim the headline CapEx numbers.
The de-risking factor.
Yes, the customer co-investment. This blew my mind.
This is perhaps the most unique structural advantage they have right now.
Okay, lay it out for us.
In a traditional defense cycle, when a contractor needs to expand capacity, they absorb the capital risks themselves. They issue debt, they build the factory, and they essentially pray that the geopolitical environment remains tense long enough for future orders to amortize that massive upfront cost.
Yeah, they take all the risk.
But the current market is completely inverted. Foreign defense ministries are so desperate for output, they are actively co-investing in Elbit's factory capacity.
They are providing capital just to secure a spot at the front of the production line.
It's an incredible dynamic. Every dollar Elbit spends on CapEx is being matched or heavily supplemented by advanced payments and direct infrastructure investments from foreign buyers.
That is just wild.
It fundamentally alters the risk profile of the company. They are drastically expanding their global industrial base using essentially zero-cost capital provided by their own customers.
The irony is incredible. Nation-states are funding the physical infrastructure of a publicly traded company just to guarantee their own survival.
Yep.
And while they are expanding outward, they are simultaneously pulling their supply chain inward through aggressive vertical integration.
A very smart move right now.
They are actively reducing their reliance on the global external supply chain by manufacturing their own foundational subcomponents, specifically things like diodes and electro-optic detectors.
To understand why this matters, you have to look at the physics and the fragility of electro-optics. Advanced targeting pods and missile warning systems rely on highly specialized detectors, often made from exotic materials like indium gallium arsenide.
Sounds expensive.
It is. And historically, the entire defense industry relied on a handful of highly specialized third-party foundries, many located in Asia, to produce these raw components.
But in a fragmented, highly volatile geopolitical environment, a just-in-time global supply chain is a massive liability.
Huge liability.
You cannot have a $2 billion EuroPLS delivery held up for 6 months because a commercial foundry in Taiwan is backlogged on a specific type of diode.
Exactly. Vertical integration is partially a margin protection play, capturing the profit pool of the sub-tier suppliers. But far more importantly, it is a schedule protection play.
Keeping the trains running on time.
Right. By bringing the manufacturing of these critical detectors in-house, they insulate themselves from global semiconductor shortages and shipping blockades.
They are controlling their own destiny. It is highly capital intensive up front, but when the global supply chain inevitably chokes, you are not waiting in line at a commercial foundry. You own the foundry.
And that operational control is precisely what gives management the confidence to project strong revenue conversion rates from that massive backlog over the next 24 to 36 months.
Right, because they know they have the parts.
Exactly. More than half of that $28.1 billion backlog is scheduled for actual delivery in 2026 and 2027. Flawless execution on the factory floor is completely non-negotiable.
All right, so tripling munitions factories and securing domestic diode supply chains, that is the now trade. That is the blocking and tackling required to execute the existing backlog.
The blocking and tackling.
But what is management doing with their massive $517 million research and development budget to secure the next trade? That leads us to what is, frankly, the most sci-fi paradigm-shifting part of the entire earnings call.
Oh, yeah.
The innovation cycle and the move toward directed energy.
So an R&D spend of $517 million in 2025 represents roughly 6.5% of total revenues.
Which is a healthy chunk.
It is. But it is important to note that this figure is heavily supplemented by external funding from the Israeli Ministry of Defense. So the true scale of their R&D effort is significantly larger than what hits the income statement.
Okay, that's a great point.
And the absolute crown jewel of this R&D cycle is directed energy.
And we are not talking about hypothetical concepts here, right? Like, this isn't just a white paper.
No, not at all.
Management specifically highlighted the operational deployment of highly advanced military-grade high-power laser solutions. And crucially, they are moving beyond those large, bulky, ground-based lasers.
Right, the stuff that takes 3 trucks to move.
Yeah. The focus is now on airborne laser pods designed to be mounted on fighter jets and high-power laser solutions for helicopters.
To understand why airborne lasers are considered the holy grail of modern defense technology, we really have to unpack both the physics and the economics. Let's start with the physical limitations.
Okay, give us the physics lesson.
Militaries have been trying to weaponize lasers since the 1970s, but they always fail in real-world deployments. Why? Because a ground-based laser has to fire through the Earth's atmosphere.
The real world has weather. Rain, fog, dust.
Right. But it is actually even more complex than just rain blocking the light. When you fire a 100-kilowatt high-power laser from the ground, the beam has to travel through miles of thick, moist air. The laser actually heats the air it is passing through. That rapidly heated air expands, changes its refractive index, and effectively creates an atmospheric lens that defocuses and scatters the laser beam before it can reach the target.
Oh, wow.
It is a physics phenomenon known as thermal blooming. The atmosphere itself defeats the thermal energy of the weapon.
That's wild. So how do you bypass thermal blooming? You just fly over it.
Precisely.
Yeah.
If you package that high-power laser into a specialized pod, mounted on a fighter jet, and fly at 30,000 feet, you are operating entirely above the clouds.
Above the weather.
You are above the dust, the moisture, and the dense atmosphere. The air at that altitude is thin and clear. The thermal blooming problem is virtually eliminated, allowing the beam to retain its destructive, melting thermal energy over vastly longer distances.
Okay, so that solves the physics equation.
Yep.
But the economics equation is why this technology is going to completely restructure the defense sector.
This is where it gets crazy.
We established at the top of the show that militaries are firing million-dollar kinetic interceptor missiles at $10,000 drones.
It is a totally unsustainable paradigm. It creates an asymmetric cost curve that heavily favors the adversary.
Right.
A non-state actor or a hostile nation can effectively bankrupt a Western defense budget simply by launching continuous waves of cheap, mass-produced, expendable drones. You run out of expensive interceptor missiles long before they run out of cheap drones.
But an airborne laser completely flips that cost curve. It offers a near-infinite low-cost magazine.
Exactly. As long as the fighter jet has aviation fuel to run the onboard turbine generator,
which powers the laser pod.
which powers the pod, you can keep firing indefinitely. The cost per interception drops precipitously from $1 million for a physical missile down to roughly the cost of a few gallons of jet fuel.
It restores the economic advantage to the defender.
Completely.
And this brings us to the most critical commercial advantage Elbit possesses right now. CFO Yakov Kigan noted something on the call that should be highlighted by every single investor listening.
Yes.
He stated explicitly that customers around the world want systems that are tested in battle.
That is the ultimate commercial moat. It is an advantage that non-conflict tested prime contractors simply cannot replicate, regardless of their R&D budgets.
Let's pressure test that. Why does a battle-tested stamp matter so much more now than it did, say, 10 years ago?
Because the nature of warfare is evolving faster than traditional procurement cycles can handle.
Right.
You can have the best PowerPoint presentation in the industry.
Yeah.
You can have flawless controlled environment test range data from the Nevada desert.
Where everything goes perfectly.
Right. But when a European defense minister is making a multi-billion-dollar procurement decision that their entire national security relies on, they do not care about the test range.
They want to know it works.
They want the specific system that successfully melted a hostile drone swarm in a chaotic, unpredictable, real-world combat environment last Tuesday.
Current conflicts are effectively serving as live, global, undeniable demonstrations for Elbit's latest technology.
Which violently accelerates their developmental feedback loop. In peacetime, it takes years to get operational data on a new system.
Years of testing and reports.
Right. Today, Elbit engineers get real-world combat data instantly. They analyze how the system performed under extreme stress, refine the targeting algorithms, push a software update directly to the deployed units, and the system becomes tangibly more lethal every single week.
Wow!
It is a compounding technological advantage that competitors stuck in peacetime testing environments just cannot match.
So let's synthesize the fundamental story here. We have a massive $28.1 billion backlog, heavily driven by a structural shift in European rearmament.
Check.
We have rapidly expanding manufacturing capacity that is actively being funded by the customers themselves. And we have futuristic, battle-tested R&D shifting the entire paradigm of air defense toward airborne directed energy. Operationally, the story is flawless.
Hard to argue with it.
But how is the street actually valuing this perfect storm? Let's dive into the investor context and examine the valuation disconnect.
Well, the performance of the equity has been nothing short of historic. The stock is up roughly 88% in the last 3 months alone and over 140% in the last year.
It's a rocket ship.
It is drastically outperforming broader defense sector ETFs like the PPA, and it's completely leaving the S&P 500 in the dust.
But here is the friction point, the analyst divergence.
Right.
Leading into this earnings print, the sell-side consensus was a very mixed, cautious hold. The established published price targets from the major banks are lagging way, way below where the tape is actually trading today.
Yeah, the street analysts are largely building their valuation models based on historical mean reversion. They look at past regional conflicts, they see the temporary spike in munitions demand, and their models automatically assume a return to baseline peacetime defense spending within 24 to 36 months.
They think the party's going to end.
Exactly. They assume the surge in orders is temporary, so they cap the multiple they are willing to pay and slap a hold rating on the stock.
But the actual market, the institutional buyers stepping up and aggressively bidding the equity higher on massive volume today is totally ignoring those cautious sell-side models.
Because the broader market is forward-looking.
Right.
The market is capitalizing a multi-year, aggressive global rearmament supercycle. It is looking at that $28.1 billion backlog, not as a temporary cyclical peak, but as a new compounding baseline for the next decade.
So for you listening, you have to ask yourself, who is right? Are the sell-side analysts right? Is this just a temporary wartime spike that will fizzle out, leaving the company saddled with overbuilt factories and excess capacity?
Or is the tape right?
Exactly. Is the aggressive price action correctly pricing in a fundamental, structural, generational shift in global defense spending?
If you weigh the macro indicators, the permanent shift in European defense postures, the technological leap in directed energy, the unprecedented reality of customer co-investment in physical capacity, the evidence leans heavily toward the tape being right.
It really does.
We are not looking at a temporary surge. We are looking at a regime change in sovereign defense procurement.
Which brings us to my absolute favorite segment of the deep dive, the part where we look at the structural realities of the market and try to figure out how to mathematically exploit them.
Oh boy, here we go.
All right, listen up. This is not financial advice. I am going to pitch you a concept like we are sitting in an investment committee meeting at a pod shop and I need capital allocation right now. We are calling this the kinetic to photonic pair trade.
I am intrigued. Walk me through the mechanics.
The macro thesis is simple. The era of the million-dollar kinetic interceptor missile is coming to a close. The math simply does not work against autonomous drone swarms. We just established that airborne lasers flip the cost curve. So the long leg of the trade is obvious. You stay structurally long Elbit Systems, or broadly, developers of battle-tested airborne directed energy and high-power laser pods. You go structurally long the photon.
Understood. But a pair trade requires a short. What is the short leg?
You short the Tier 2 and Tier 3 legacy suppliers. I am not talking about shorting the massive diversified prime contractors. They have enough legacy cash flow and diverse revenue streams to survive the transition. I am talking about aggressively sorting the specialized mid-cap machine shops and component manufacturers whose entire revenue stream is dependent on building the physical metal components for traditional ground-based kinetic interceptor missiles. You short the companies manufacturing the physical actuators. You short the manufacturers of solid-state rocket motor casings.
Because if the total addressable market for kinetic interceptors collapses,
the total addressable market for those highly expensive kinetic interceptors will eventually crater. Western defense budgets are finite. Every single dollar a defense ministry pivots toward buying an infinite magazine laser pod is a dollar ripped directly out of the budget for procuring expensive physical missile stocks.
the logic is sound, but how are you structuring the funding for this short position? Because shorting defense midcaps in the middle of a geopolitical bull market is incredibly painful. You will get squeezed.
You don't short the equity directly. You fund the short position using the massive implied volatility stew currently present in the defense sector options market. Right now, retail and institutional money are aggressively buying out-of-the-money call options on anything defense tech related because they're terrified of missing the next geopolitical headline. Upside calls are historically expensive. They are overpaying for convexity. So you sell those wildly overpriced out-of-the-money calls on your long-directed energy position. You harvest that massive premium, and what do you do with that cash? You use it to fund long-dated, out-of-the-money put options on the legacy kinetic component suppliers. You are creating a market-neutral pair trade that is financed by the market's own geopolitical panic, and it literally pays out when militaries officially transition from kinetic defense to photonic defense. You are arbitraging the speed of technological obsolescence.
Okay, I have to admit, it is aggressive, it is highly complex, but the underlying logic regarding the asymmetric cost curve of modern conflict is entirely sound. If high-power airborne lasers become the standard counter-drone and counter-artillery solution over the next 5 years, the supply chain for traditional interceptors will face a severe structural contraction.
The kinetic to photonic pair trade. Run the models on it. Look at the volatility skew. But again, to be absolutely clear, that was a thought experiment. None of this is financial advice.
Always do your own due diligence and consult a professional. Seriously.
All right, let's bring the energy back down and recap exactly what we covered today. This was a phenomenal quarter for Elbit Systems, built on 3 solid pillars. First, the margin-expanding revenue beat, driven by high-margin software and electronic warfare systems, dropping to the bottom line and proving sustained operating leverage.
Second, that massive $28.1 billion backlog, heavily driven by the structural shift in European rearmament and the brilliant Euro PLS localized API-style manufacturing strategy.
And third, the transition to the future. Airborne laser technology and directed energy, providing a battle-tested commercial moat that is fundamentally altering the economics of global air defense.
It is the definitive story of a company transitioning from a regional player to a globally scaled, capacity-constrained platform.
And I want to leave you with a final provocative thought, something we touched on briefly, but has massive chilling implications for the future of capital markets. We talked about how foreign defense ministries are actively co-investing in Elbit's factory capacity. They are providing capital just to secure a spot in line for manufacturing output.
Right, which fundamentally de-risks the capex for the company.
Right. But think about the philosophical shift happening there. If nation-states are now demanding co-investment rights just to ensure they have enough artillery and defense electronics to survive a conflict, are we entering an era where publicly traded defense companies stop functioning like traditional equities?
Oh, wow.
Are they beginning to function more like sovereign assets? And if a public company becomes a critical physical sovereign asset to multiple competing nations simultaneously, how does the open market even begin to value that?
That is the multi-billion-dollar question that the sell-side analysts are completely missing.
Yeah.
When national survival overrides traditional return on invested capital metrics, the old valuation models break down completely. We are in uncharted territory.
Something to mull over as you adjust your screens this week. That does it for this deep dive into the Q4 2025 earnings call. Once again, nothing discussed here is financial advice. We invite you to review your own models, dig into the data, and join the conversation. We will see you for the next quarter.